Hey, it's Max from UNFTR for the MeidasTouch Network. And Midas is actually a pretty good theme for us today, as in the curse from the fable where everything the king touches turns to gold, or in the case of King Donald, gold plated. Like the gold plated ornaments in the White House, the US economy is shining on the surface. Beneath the facade, though, things are getting kind of bleak. So today we're going to lift the hood to reveal the troubling signs about the state of the economy below the surface. And to help us build a narrative, we'll discuss Moody's, debasement, and contango, which sounds like a bad underground salsa act from the 1980s, but it'll make a lot more sense as we go on. And we'll talk about two actual gold phenomena: Goldman Sachs and gold reserves. And I promise you, that's the end of wordplay. So let's get down to business. So I've been saying for a while on Midas that the economy has become K-shaped. Now, in the past, this term was meant to describe economic recoveries, where the top end of the market recovers faster than the bottom. So think post-2008 financial crisis, where Wall Street bounced back really quickly, but Main Street struggled for years. But this phenomenon has become so entrenched, so permanent, that the term now describes something more fundamental: a bifurcated economy that is splitting apart at the seams. So we're going to cover a few economic terms today that you're probably going to hear a lot about going forward, and we'll explain what they mean and provide concrete examples of how the top end of the economic spectrum isn't just separating, it's accelerating. And to illustrate this point, let's start with something that just dropped from Moody's Analytics. Mark Zandi from Moody's Analytics set off a brief firestorm recently when he released indicators showing that 22 states plus DC are already in recession. That's nearly half of American states in economic decline right now, even though the White House keeps telling us that everything is tremendous. So the state-level recession index isn't just looking at employment numbers, although that's part of it. So it's drawing also from personal income, modeled industrial production, housing starts, credit performance, and migration patterns. And what it reveals is a patchwork economy with startling differences from state to state. So the recession-impacted states are geographically scattered, but there is concentration in the Midwest, the Plains, and the Northeast. So what do these have in common? Well, first off, over the summer especially, Canadians didn't come to the States. So a lot of these border states did really poorly when they usually do well with tourism. Then you got federal job cuts, which especially killed the DC area, slowing immigration that had been filling crucial labor gaps, rising tariffs that are hammering trade-exposed regions, and declining manufacturing sectors facing weaker demand for goods as global trade contracts. So that part actually doesn't get enough attention. We're 6 months into the heart of Trump's tariff regime, and manufacturing isn't gaining, it's not even stabilizing, it's losing ground. So these aren't random economic hiccups. These are the direct consequences of policy choices. Tariffs that, even though it's supposed to make us stronger, are making American manufacturing less competitive, just like it did in the 1930s when we tried it. Immigration restrictions that leave farms and factories shorthanded, of federal workforce restrictions that ripple through the entire regional economy. Now, here's where it gets really interesting. While 22 states are sliding backward, another third are just treading water, barely keeping their heads above water. But there's a group of southern states in particular, like South Carolina, Florida, Texas, North Carolina, that are all still in expansion mode. So why? Well, strong population inflows for one. Census data shows that the South has seen massive in-migration since 2020, driven by affordable housing, lower taxes, and more business-friendly environments. So these states experienced a boom in real estate and also construction as a result of the post-COVID migration. So more people means expansion in services as well: professional services, healthcare, financial activities, leisure, and hospitality. So that inflow has provided some insulation for now. There's also defense and aerospace investments because the southern economies have benefited probably a little bit more than other areas. It's one of the few areas of government spending that has increased. So states like South Carolina are leading the nation in personal income increases and job gains, outpacing national averages. So on paper, they look great. But here's the problem. And this is where the Trump administration's policies become a ticking time bomb, even for states that look like they're currently thriving. So, you know how the government is totally shut down and stuff, and Democrats are all like, well, you have to stop people from being sick, and Republicans are all like, we don't care, and Democrats were like, well, then shut it down. Republicans were like, fine by me. Yeah, that's where we are, right? This fight over Medicaid is super important. So dig this. Many of the not yet in recession states that we just mentioned are the ones with the highest reliance on Medicaid support from the federal government. Mississippi gets 81 to 82% of its Medicaid costs covered by the federal government. It's the highest in the nation. And Medicaid represents 25% of their entire state budget. Kentucky is at 81% of federal support, with Medicaid making up 33% of their budget. New Mexico's at 80% federal funding, covering 34% of their total budget. West Virginia, Arizona, Arkansas, Alabama, South Carolina, Oklahoma all receive 70 to 80% federal support for Medicaid, with the program representing anywhere from 22 to 34% of their state budgets. So let me ask you something. What happens when you slash funding to a program that represents a third of a state's budget? It's a nightmare in the making, and should be noted, by the way, these are all red states. It's just unbelievable that you have Democrats standing up to the red state Republicans over this issue in particular. These cuts will force states into impossible choices: either raise taxes dramatically during the economic slowdown or gut healthcare, education, and other services. Either option kills more jobs. All right, let's talk about contango, which sounds like a dance move from Dirty Dancing, but it's actually one of the more important economic indicators that you're probably not hearing about in mainstream coverage, and it's all about oil. So right now, crude oil is trading below $60, which means that most U.S. oil and gas companies are losing money on drilling. Contango in the crude oil market means that oil traders expect prices to be higher in the future than they are today. So it seems like a good sign, right? Actually, the opposite is true. It means that traders currently know that there's too much oil being produced compared to what the world is going to need. So when supply overwhelms demand, companies have to store the excess oil. The cost of storage, renting tankers, maintaining facilities, insurance, etc., pushes up the price of future contracts. So you get this weird inversion where oil is cheaper today than it will be 6 months or a year from now, which means contango is a giant red flag that demand for oil today is weak, and they're anticipating it continuing to be weak, which points to broader economic problems, mind you. Slowdown in global manufacturing, reduced shipping activity, less air travel. So when businesses and consumers are using less oil, it tells us that economic activity has slowed down significantly. Maybe because of reduced consumer spending. Maybe softening industrial output, maybe financial stress spreading across countries because, remember, crude oil is fungible. It's a global commodity, so it's not just signaling to us, even though we like to think everything's about the United States. It's signaling that the economy writ large is all sizzle and no steak. So persistent contango, especially when accompanied by rising oil inventories, is often a warning sign that the world economy is experiencing a slump, or that a recovery has stalled completely. And here's the direct correlation again. Trump's tariff war has artificially slowed down global trade projections. Remember all those companies that front-ran tariffs by rushing to import goods before the new taxes hit? That artificially propped up the global freight market for months. But now, orders are slowing. Hiring forecasts for the holiday season are dismal. Layoff announcements are accelerating. So why is global activity slowing? Because we're still the largest consumer market in the world, and our erratic trade policies have thrown sand in the gears of global commerce. When the United States suddenly becomes an unreliable trading partner, when tariffs can be imposed or removed on a whim, global businesses just pull back. They delay investments, they reduce orders. They want to see what fresh chaos tomorrow brings. So the contango in oil markets is directly reflecting Trump's chaos. It's the physical manifestation of global economic uncertainty caused by one man's inability to understand how trade actually works. And that brings us to debasement, which isn't just the space beneath your house. See what I did there? No, I'm talking about dollar debasement specifically, and this refers to the sharp and highly publicized decline in the value of the US dollar throughout 2025. And we're not talking about a minor adjustment here. The US dollar index fell by nearly 8 to 11% in the first half of 2025. It's the most significant depreciation since the 1970s. I mean, think about that. The worst dollar decline in 50 years. So investors have responded by shifting assets away from the dollar and toward inflation hedges, especially gold. Also silver, but especially gold. So gold is up over 50% in 2025. Bitcoin has also soared because it too is considered a scarce asset. So this movement has a name. It's called the debasement trade. And this is where investors seek scarce assets as a protection against a declining fiat dollar. So what's driving this? Well, ballooning U.S. budget deficits for one. Also expectations of easier monetary policy. I mean, everyone knows our economy stinks and that we did it. And the Fed's going to have to print money again soon. They've already signaled as much. You've got persistent inflation despite interest rate increases. That's stagflation, and that's a nightmare. You got global de-dollarization, with central banks around the world actively diversifying away from the dollar, and political uncertainty about U.S. fiscal sustainability. The weakening dollar raises import costs for American consumers as well, which could reignite inflationary pressures, especially at this holiday season, which is also a disaster. So we can't even take advantage of those cheap oil prices. It erodes the real value of dollar-denominated savings and bonds. I mean, yeah, a cheaper dollar provides some support to U.S. exports, but again, manufacturing is 10% of the U.S. GDP, and as we've said before, it's shrinking, no matter what Trump says. Then you got people like Scott Bessent. Remember the guy who lost 90% of his investors' money when he ran his own hedge fund strategy? That's Scott Bessent. Remember, he lost more than $4.5 billion while the S&P gained 167% over the same time period, which means that a monkey putting a stack of cash on a roulette table would have done better. That guy, yeah, he'll tell you that U.S. Treasury auctions are still finding buyers, and it's great. And that's fair. We are. But what we don't know is who's doing the buying, because the buyers have changed dramatically in recent months. We're seeing a shift away from institutional investors like central banks, those stable, long-term holders like central banks and pension funds, etc. That's not a sign of strength because it's moving to private buyers. We don't know who they are. This is a sign that the traditional pillars of dollar demand are just breaking down. And I'd love to tell you more about it, but data releases from the Treasury are also slowing down, leading it to post this super mature message. The radical left has chosen to shut down the United States government in the name of reckless spending and obstructionism. Can you be more childish? The world is losing faith in the major economies to manage budgets responsibly and institute stable trade agreements to get the global economy back on track. Everything is reorienting as a result of Trump's chaotic behavior and policies. The dollar's role as the global reserve currency, which has been America's superpower since World War II, is being actively undermined by the very people claiming to make America great again. Now let's talk about the top of the K, that part of the economy that's absolutely thriving while everyone else struggles. Now this is just one example, but I think it's going to resonate. Goldman Sachs just announced that they're cutting 1,000 employees, saying that they're getting rid of lower performers and any roles that could be, quote, more efficiently handled by artificial intelligence. So this announcement came right after they reported the most profitable quarter ever. Third quarter profit for Goldman Sachs jumped 37% to $4.1 billion. $4.1 billion profit in a single quarter, and they're announcing layoffs. So this demonstrates a few crucial things about our economy. First of all, while we may be in an AI capital bubble, meaning the massive investment into AI infrastructure might not deliver the revenue gains that everyone's expecting to AI-specific companies. The efficiency gains from AI are already decimating the labor market, even at the top end of the spectrum. I mean, Goldman Sachs employees aren't exactly minimum wage workers. These are high-skilled professionals getting replaced by algorithms. And here's the truth about corporate America that they were never going to admit to us. They were never, ever going to use AI to increase productivity and maintain workforce levels, ever. It was always a lie. They were always out to use AI to cut headcount, to boost profits and reward shareholders. But the second reason the Goldman example is critical is because they are the most recognized investment bank in the world. And the reason they're doing so spectacularly right now tells you everything about who this economy serves. Goldman is thriving because of the tremendous pace of mergers and acquisitions. That's where they make their money on fees. Trump's deregulation agenda and tax cuts are leading companies to consolidate at a breakneck pace. The threat of challenges to monopolies has virtually disappeared with the replacement of tough FTC leaders like Lina Khan, who actually tried to protect consumers and workers from corporate consolidation and monopolies. Goldman is also raking in massive fees from managing investments into data centers to support the expansion of that same AI economy that's putting their people out of business. They're facilitating the very infrastructure build-out that will ultimately eliminate millions of American jobs. You don't have to be an AI booster or an AI detractor to understand that this is happening already. So what this shows is that the entire economic policy of this administration is anti-worker, anti-manufacturing, anti-farmer, and only cares about the gilded economy at the very top. The big guys, the Wall Street firms, are getting fatter and richer, scheming for ways to replace their people with technology while paying less in taxes than ever before. There is no one in this administration looking out for the little guy. Not when 22 states are in recession while Goldman reports $4.1 billion for a quarter in profit. Not when Medicaid cuts are about to devastate entire state budgets while corporations get more tax breaks. Not while farmers are getting crushed by tariff retaliation while investment banks facilitate monopoly mergers. Not when manufacturing workers are losing jobs while Wall Street celebrates deregulation. And who are we sending support to instead, to the tune of $20 billion?
This is the president of Argentina, Javier Milei.
Yeah, I'd be scream singing too if somebody sent me $20 billion in cash. This is the K-shaped economy in its full and brutal reality. The top is shooting off to the stratosphere, powered by AI efficiency gains, merger mania, deregulation, and tax cuts. And the bottom is sinking under the weight of recession, of job losses, federal funding cuts, and trade war casualties. Welcome to Donald Trump's gold-plated economy. For the MeidasTouch Network, I'm Max from UNFTR. You can find me on YouTube and Blue Sky at UNFTR. And don't forget, sign up for our free weekly newsletter and browse our directory of progressive articles and resources at UNFTR.com. Thanks as always to the Meidas Mighty for having me here, and I'll catch you next time.
Love this video? Support independent media and unlock exclusive content, ad-free videos, and custom emojis by becoming a paid member of our YouTube channel today. You can also gift memberships to others. Let's keep growing together.